A tax bracket is a range of income levels that are subject to a specific income tax rate. In progressive income tax systems, higher income levels are taxed at higher rates, and the income is divided into different brackets. As individuals or businesses earn more income, they move into higher tax brackets, and their tax rate on the additional income increases accordingly. Key points about tax brackets. Progressive tax system. Most income tax systems around the world, including the United States, use a progressive tax structure. In a progressive system, as income increases, the tax rate also increases. This is in contrast to a flat tax, where all income is taxed at the same rate. Marginal tax rates. Each tax bracket has an associated marginal tax rate. The marginal tax rate is the rate applied to the last dollar of income earned within that bracket. It represents the percentage of tax paid on the next dollar of income. Tiered structure. Tax brackets are typically organized in a tiered or step-like structure. As income rises, it moves through different brackets, with each bracket having its own specific tax rate. Income calculation. When determining the total tax owed by an individual or business, the income is divided into segments based on the applicable tax brackets. The tax owed is calculated by applying the corresponding tax rate to each segment of income. Effective tax rate. The effective tax rate is the average rate at which income is taxed across all tax brackets. It is calculated by dividing the total tax paid by the total income. The effective tax rate may be lower than the individual's highest marginal tax rate. Example of tax brackets. Let's consider a simplified example of a progressive tax system with 3 tax brackets. Bracket 1, 0% to $50,000, tax rate is 10%. Bracket 2, $50,001 to $100,000, tax rate is 20%. Bracket 3, over $100,000, tax rate is 30%. If an individual earns $80,000 in taxable income, the calculation of the income tax owed would be as follows. Bracket 1, $50,000 by 10%, $5,000. Bracket 2, $30,000 by 20%, $6,000. Total tax owed equals $5,000, bracket 1, plus $6,000, bracket 2, equals $11,000. In this example, the individual falls into both bracket 1 and bracket 2, paying the corresponding tax rates on the income within each bracket. Considerations. Marginal versus average tax rates. It's important to distinguish between marginal tax rates, the rate on the last dollar earned, and average tax rates, the overall rate applied to total income. Individuals often pay a lower average tax rate than their highest marginal rate. Tax credits and deductions. Tax credits and deductions can influence the effective tax rate. These reduce the amount of taxable income and, consequently, the overall tax liability. Tax planning. Taxpayers may engage in tax planning to optimize their finances within the tax code. This may involve managing income, taking advantage of deductions, and utilizing tax-advantaged accounts. Changes in tax laws. Tax brackets and rates can change due to amendments in tax laws. Governments may adjust tax policies to address economic conditions, fiscal priorities, or changes in income distribution. Social Security and Medicare taxes. In addition to income taxes, individuals in some countries, such as the United States, may be subject to payroll taxes for Social Security and Medicare. These taxes are often assessed at a fixed rate and are not part of the progressive income tax structure. Understanding tax brackets is essential for individuals and businesses to estimate their tax liability, engage in effective tax planning, and make informed financial decisions. Taxpayers should be aware of changes in tax laws and leverage available strategies to manage their tax obligations efficiently.